So the unstoppable force that is the S&P 500 has been plummeting, with fears of a US recession around the corner. Personally, I'm down over £10,000 in just the past few days. Ouch. And if you're like me, you'll be feeling the pinch too. Whether it's through individual stocks or an index fund, we're pretty much all riding the wave that is the S&P 500. And yes, sorry if you haven't looked yet, it's probably best not to. So let's talk about what's been going on, what's causing the big drop in prices, and what we should expect to come. And most importantly, what you need to do about it. And before we begin, just a quick reminder, I do send out a newsletter right away when things like this happen, which is completely free for you to sign up for. So if you want to see these sooner, as these videos do take time to make, do sign up for that. I also send out some free goodies, so it's worth joining. So what's been happening with the stock market? The S&P 500 is down 5% in the past few days. And as you can see, when we look at the past 6 months, there really is quite a sharp drop off here to where we were just a week ago. Among some of the worst hit were Microsoft down 7% over the past 5 days, Nvidia down 10%, and Amazon down nearly 14%, which is pretty huge. Perhaps even more shocking than these is the Nasdaq is down 11% from its recent peak. The difference with the Nasdaq is it has 100 of the top companies in America, whereas the S&P 500 has, of course, 500. For this reason, the Nasdaq tends to have more tech-based companies, and this plays into two parts. One is that generally the faster the stock rises, the more volatile it can be on the way back down. But also is something to do with what's been going on in the tech sector, which is this. The primary driver of the downturn this week is a weak jobs report in the US. The latest data from the US Labor Department showed only 114,000 jobs were added in July, well below their expectations of 175,000. Alongside the jobs being less than expected, the unemployment rate also unexpectedly rose to 4.3%, which is a new 3-year high. This spike in unemployment triggered something called the SARM rule, created by a Federal Reserve economist, Claudius Sarm. The rule aims to indicate the likely start of a recession when the unemployment rate's 3-month moving average exceeds the lowest point over the past 12 months. Don't worry, it sounds way more complicated than it actually is. But all you need to know is that this employment data spooked investors, which has shifted the sentiment from viewing a weaker economy as a potential for rate cuts to fearing a deeper economic slowdown. We've essentially flipped from a position where a weaker economy was seen as bullish, i.e. the market rising, to a weaker economy being bearish and stocks falling. And in particular, the tech industry saw the biggest drops in available jobs, with a 20,000 decline in jobs, whereas other industries like health gained 57,000 and 25,000 in the construction industry, which wasn't great news for the tech industry, which has been soaring this year, which has caused a lot of investors to feel nervous about the drop to come. And if this is the end of the big tech soar that we've seen recently. Speaking of tech, I'd like to thank the sponsor of today's video, Anker. As a content creator and web designer, I have a ton of different devices I need to keep charged. From my camera equipment to microphones, iPhones and iPads, I lose track of all the different charging devices I have, and it leads to extremely messy cable management. The Anker Prime range is perfect for solving this problem. There's the Prime wall charger, which is the smallest 100-watt multi-port wall charger on the market, 45% smaller than the others. With one USB and 2 USB-C ports, it utilizes gallium nitride technology, which allows for small build while not compromising on output strength. And what's crazy is it monitors the temperature 3 million times per day for extra safety. The USB-C cable allows for ultra-fast charging up to 240 watts, and it's extra durable and it has up to 5 times less chances of getting tangled. And the outer layer is made of 100% recycled material, which is an added bonus. I also use their supercharged desk charger, which has a huge 200 watts of charging across 6 ports, so I can charge up to 6 devices at the same time. And this one does 6 million checks per day, so I can be sure I'm safe. The 250 watt model is launching a little later, which will be a 250 watt instead of 200 watt, and it also comes with a smart control dial, allowing you to set different power for the ports. And if you really want to go all out, the Anker Prime docking station allows you to connect 14 devices at once and can charge a MacBook Pro in under 2 hours. The smart screen digital display shows real-time charging status, port status, and alerts for any abnormalities. The full Anker Prime line includes 3 chargers, 1 cable, and 1 docking station. All of the links are down below in the description. These devices have been a game changer for me and saved me so much hassle and space on my desk. They've given me a discount code so you can save 15% by using code AnkerPrime03 at checkout, and there's now £25 off the 250-watt model. If your setup is in need of a major upgrade like mine was, I recommend you check them out. The second thing affecting the market has been that short-term traders have been driving a global sell-off of stocks. What this means is that hedge funds and other short-term investors have been selling off stocks in masses, which has accelerated the market's decline. Traders are now hesitant to stay in long-term positions now that the major earnings season is over, where they announce their financial results. But despite this, traders remain confident the chance of a recession remains low, and they say that people reacting to this drop as a recession seems pretty irrational. The third main factor playing into this drop is the Federal Reserve. Investors were hoping for a rate cut. The Bank of England has cut its rate to 5%, which people have been long waiting for. This cut is often seen for growth and investing as a positive, and people were hoping that the USA would follow suit. But the chairman of the Federal Reserve, Jerome Powell, only hinted that a cut could be on the table for September, which isn't very clear whether it'll happen or not, and this has caused doubt with traders who really like certainty. This indecision has drawn criticism, feeling like their actions are behind the curve, and the market was hoping for a more immediate action to address the slowing economy. Now, you might think that the sharp drops were due to big losses in mega-cap stocks. While companies like Intel and Amazon did see significant declines, Intel dropped 26% after a big earnings miss and layoffs, and Amazon fell 14%. Not all tech giants suffered. Apple, for example, emerged from the initial drop slightly up after posting better than expected iPhone sales, but they did feel the hit on Monday. But it hasn't stopped Warren Buffett, perhaps the world's most famous investor, from dumping over half of his stock in Apple. This is significant because Apple was the largest single holding in their portfolio, making up almost 40% of the fund. Since the end of 2023, Berkshire Hathaway, Warren Buffett's company, has sold 505 million Apple shares, 115 million in the first quarter and another 390 million in the second quarter. As of June 30th, that represents a 55.8% reduction in Berkshire's Apple holdings since the beginning of the year. So the question is, why did he sell so much Apple stock, and should other investors be following suit? Well, no one really knows, as he hasn't commented, but most believe it could be due to Apple's tepid growth rate and high valuation that suggests why he may have concluded that the stock's prospects are not really great, which for a stock he's been so confident with seems like a huge move. But the stock market dropping isn't just limited to the US. European markets in the FTSE 100 also saw declines, although not quite as severe. Tokyo's Nikkei 225 index closed down 12.4%. In less than 4 weeks, the Nikkei has dropped 25% after reaching a record high on July 11th. During the same time period, the yen has strengthened, now trading around 142 to the dollar, compared to approximately 161 to the dollar in early July. These are significant market movements that typically span months or years, have occurred within days due to investor reactions to developments in the USA and Japan. The US economy is showing signs of slowing, with the Federal Reserve expected to start cutting interest rates in September, which they do when growth typically slows, while the Bank of Japan actually raised rates on July 31st, which signaled a readiness to continue doing so. After declines on Friday and Monday morning, the Nikkei experienced a dramatic fall on Monday afternoon, a drop not seen since October 20th, 1987, which followed the Black Monday in the US, where the Dow Jones dropped a whopping 22%. Although US interest rates remain higher, the narrowing gap has made the yen more attractive. For years, global investors have favoured what could be seen as riskier assets like US stocks, funding these trades with the yen due to Japan's ultra-low interest rates. Many hedge funds and asset managers had anticipated that rates would remain low and the yen weak. This strategy, known as a carry trade, was profitable until the Bank of Japan raised rates, leading to a 7.6% appreciation of the yen against the dollar over the past week. According to analysts, the raising yen caused a squeeze on the carry trade. Investors who borrowed yen faced margin calls as the currency strengthened, forcing them to buy yen to cover their positions, further driving up the yen's value. Because more investors were compelled to unwind their positions, leading to a one-way market, trading volume in Tokyo on Monday was more than double the daily average for the past year, which is crazy. crazy. With the shift towards safer investments, the yield on Japan's 10-year government bonds fell to 0.75%, down from over 1%. Remember that bond prices rise when the yields fall. A stronger yen reduces the competitiveness of Japan exporters and lowers their yen-denominated earnings from overseas sales. Weak US demand would also negatively impact Japanese companies, particularly in the automotive and electronics sectors. Financial stocks in Japan were severely affected due to the decline in long-term interest rates. These moves would be usually seen during major market events like COVID-19 or significant economic downturns, such as the 2008 financial crisis. Japanese stocks were impacted by the unwinding of large positions that had recently been built in the global markets. The influx of money into major US tech stocks had spilled over into Asian markets because of the critical role of Taiwanese, South Korean, and Japanese companies in the global tech supply chain. However, this trend has reversed, with Tokyo Electron, a semiconductor manufacturing equipment maker, dropping 18% on Monday and 46% since its peak in April. Tokyo stock prices are now pretty attractive, though investors may want to wait for more stability. Marcella Chow, who is a global market strategist at JP Morgan Asset Management, said that the market would likely shift Fed policy in the US, influencing the dollar-yen exchange rate and stocks. In Japan, policymakers might intervene to support the markets. Now, for the most part, most of that might go over your head, and you likely won't have much involvement in the Japanese markets, but they do make up a portion of the majority of index funds. For example, my Vanguard Developed World Fund's second largest holdings are in Japan, 6.5% of the fund, so it is pretty significant to recognise what's happening over there. And other global funds will be pretty similar to this one. I really like to be aware of what's going on in the world and what's impacting my portfolio. And I know seeing these drops in your portfolio is pretty scary. I'm down £10,000 already with these recent drops, and I expect it could go more. Which of course makes you want to pull your money out and stick the money in the bank instead. I mean, why would you stay invested when you can get 5%? But this is really what you have to remember about investing. Try to think of it like this. When you retire, whenever that might be, let's say it's in 20 years' time, whatever price that index fund is going to be will already be. Obviously, it can change in the short term and things will impact that. But let's say something like an all-world fund is £100 each today. When you sell it in the future on the 20th of August 2044, it's going to be £300 per one unit. Well, that price is going to be that either way. And the question comes then, would you rather buy that one thing that you're going to sell for £300 in the future at £100 last week or £90 now because it's dropped 10%? Think of it like the prices are now cheaper and they're essentially on sale to buy the same stock, and you're better off buying it now at this price than you were last week, even though it's down. The stock market does and always will move in cycles. Trying to time it, you'll end up missing out on the best days of the stock market and ending up worse. For example, if you look at $10,000 invested in the S&P 500, this shows the impact of missing out on the best days between Jan 2003 and December 2022. If you would have remained invested, you'd have ended up with 64,000. If you'd have missed out on just 10 days, you'd have only gotten 29,000. And what's even crazier about this is that 7 out of the best 10 days happened in a bear market, when the market was going down. And as you can see, if you'd have missed out on over 30 days, you would have really messed up. All of my best returns from 15 years of investing have been when the market has dropped. COVID in particular was probably the best I've ever done from investing because I kept investing and stayed the course. This is why I can't stress enough that you need to buy on a regular basis and don't panic. Just keep buying the dip. You really want to be buying now and not when everything is going smoothly upwards, as crazy as that sounds. I know we would all like to see one smooth line upwards and keep buying, but those times when it does dip is when you need to buy it and it is on sale. I'll be buying more today and I'll continue to buy every month, whether it's up or down, just as my plan says. And in 5 or 10 years time, I'll look back and not even remember that this drop even happened. Also, remember that ignoring these past few days, 2024 has been an amazing year for US stocks. The S&P 500 surged by almost 20% between January and July, while the Nasdaq skyrocketed even more by over 25%. So you really have to take the good with the bad, and 9 times out of 10, you're just better off not looking. If you want to check out how my portfolio has been doing and how I finally just reached my third 100k portfolio, you can check it out right here. And I will be doing a total portfolio update soon for my birthday, which will be my complete net worth reveal, and I'll share everything with you on my journey to financial independence. So make sure you subscribe for that one, and I will catch you in the next video. And most importantly of all, just don't panic.